What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday, everybody. I hope you're having a lovely weekend. Some of the big news this week in relation to the US-China relationship has been how the Biden administration will react to China's failure to meet its commitments under the so-called Phase 1 trade agreement signed between Beijing and Washington during the Trump administration, which expired at the end of last year. Of course, every man and his dog could see months ago that China was unlikely going to meet its commitments under the agreement. There is still some debate among analysts and economists about just how behind Beijing is on these payments. For example, according to calculations by the Peterson Institute for International Economics, from January 2020 through November 2021, China's imports of relevant goods reached 62% of the Phase 1 target. Others have argued that the figure is even lower. During testimony to the House Agriculture Committee, U.S. Agricultural Secretary Tom Vilsack said China had not lived up to its promise under the Phase 1 trade agreement. Quote, "They are 13 billion short on purchases, and there are 7 key areas where they have yet to perform." End quote. At any rate, the ball was very much in Washington's court. This week, US President Joe Biden said that he would not be lifting tariffs imposed during the Trump-era trade war because Beijing had failed to deliver on their promises under the trade deal. Beijing, which is facing economic slowdown itself, was unsurprisingly unhappy with this, with the Ministry of Commerce expressing through a spokesperson yesterday, quote, "The Chinese side has always believed that cancelling the additional tariffs is good for China, the United States, and the world, especially under the current inflationary situation. Lifting additional tariffs is in the fundamental interests of consumers and producers in both China and the United States, and it is conducive to the recovery of the global economy." End quote. Meanwhile, yesterday, Friday, the US government said it would suspend 44 China-bound flights from the United States by 4 Chinese carriers in response to the Chinese government's decision to suspend some US carrier flights over COVID-19 concerns. Since late December, Chinese authorities have suspended 20 United Airlines, 10 American Airlines, and 14 Delta Airline flights. The US suspensions will begin on the 30th of January, with flights by Xiamen, Air China, China Southern Airlines, and China Eastern Airlines affected. Okay, next up, 2 Taiwan-related updates. Lithuania has felt the full blow of China's economic stick. The UN country's exports to China suffered what some commentators have described as a quote-unquote near-total collapse in December after the Baltic state took moves to get closer to Taiwan diplomatically. We have been following the Lithuania-China story for a while now, as it acts as a good case study of how Beijing seeks to use its market access as a stick to disincentivize nations from moving too close to Taiwan, diplomatically or otherwise. The dispute began when Lithuania decided to host a diplomatic mission from Taiwan, which was named in a controversial manner from Beijing's perspective. Customs data published on Thursday show that shipments from Lithuania to China dropped an incredible 91.4% in December from a year earlier and down 91.1% compared to the month before. Slovenia may be next in line for this treatment after the nation's prime minister called Taiwan a country this week and expressed a desire to follow Lithuania's example in hosting a special diplomatic mission. Meanwhile, several media outlets are reporting that the United States is looking for ways to potentially accelerate delivery of next-generation F-16 fighter planes to Taiwan. According to outlets in the United States, Taiwan, and Hong Kong, US officials, speaking on the condition of anonymity, have expressed to journalists that the United States is trying to find a solution to speed up the delivery of Lockheed Martin Block 70 F-16s, which are currently set for delivery in late 2026. Earlier this week on China Update, we discussed Taiwan passing a massive military package, adding billions of dollars of equipment to the island's defenses, including to develop surface-to-surface missiles capable of striking deep within the Chinese mainland as far as Nanjing and Wuhan on the Yangtze River. According to calculations by the US-based RAND Corporation, Taiwan's Air Force in 2020 scrambled 2,972 times against People's Liberation Army Air Force aircraft at a cost of $905 million. This week, the Hong Kong-based South China Morning Post published an excellent piece on the funding situation for Belt and Road Initiative projects in Africa. Quote, "In the past, joining the Belt and Road came with high prospects of funding, often for huge infrastructure projects from Chinese policy banks, MX Bank of China and China Development Bank, but these banks are now demanding feasibility studies amid debt distress in the continent." End quote. With the slowdown in the Chinese economy and a more conservative Beijing, the, quote, "heady days of ill-considered projects and wild spending have been temporarily put to rest," end quote, as one academic interviewed by the piece explained. Another academic and founder of the New South Economics, Lauren Johnston, expressed that Chinese investment was changing in Africa. It used to be big Chinese investments were involved in large infrastructure projects, especially in the energy sector. Quote, "But now the focus is on realizing some of that value, such as getting the exports moving and getting employment going up and moving some of the value chains." End quote. However, a senior credit research analyst at Reed Intelligence interviewed expressed that the Belt and Road had been, quote, "exaggerated as a driver of Chinese lending in Africa," end quote, pointing out that overall Chinese lending to Africa peaked back in 2013. The senior credit research analyst observed, quote, "For Beijing, the main incentive is to tie Belt and Road countries closer politically and increase its support in forums such as the United Nations General Assembly," end quote. Okay, last up, Evergrande. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. I have included a nice visualization here provided by Bloomberg this week of what Chinese property developers need to repay or refinance in the coming years. And we can see here that they are on the hook for almost $100 billion this year. On Thursday, Chinese developer Yuan declared in a filing to the Hong Kong Stock Exchange that it was unable to pay off the principal of two notes amounting to $688 million due on Thursday and on the 23rd of January, tomorrow, Sunday. The following day, yesterday, in response to these moves, ratings agency Fitch downgraded China Yuan Group Limited's credit rating to restricted default. The firm said any failure by Yuan to honor bond principal payment is consistent with its definition of restricted default, as the borrower has, quote, "experienced an uncured payment default on a material financial obligation," end quote. And it is not just Yuan that is having a bad week with the ratings agencies. On Thursday, Chinese financial media outlet Caixin Media reported that Fitch cut ratings on Sunac China, another major developer, for decreasing financial flexibility. The report explains that the company needs to repay 928 million RMB of asset-backed securities due on the 9th of February and 3.1 million RMB of onshore bonds. While the company's liquidity improved after equity placements in November and January, it's expected to require more cash, with Fitch expressing, quote, "any asset sales will face adverse market conditions, and failure would result in rapid erosion of its liquidity buffers," end quote. Indeed, the day after the Fitch rating reduction, S&P also lowered Sunac's long-term rating by one notch to BB-, with the developer's outlook at negative. Now, let's turn to Evergrande itself. On Thursday, an ad hoc offshore creditors group of China Evergrande said that it had, quote, "no substantive engagement with the firm over its restructuring plans, despite the firm's repeated assurances," end quote. As such, the group, represented by a major law firm and investment bank, expressed that, quote, "it has no option but to seriously consider enforcement actions, and it is prepared to take all necessary actions to defend its legal rights," end quote. On this theme, it is being reported on Friday that the Guangzhou Local Government Working Group, leading China Evergrande's restructuring, wants to separate the country's offshore assets and sell them to pay off foreign debt. This development is still in the air, and we need to see whether there is some truth to it over the next few days, but if accurate, it would be music to the ears of foreign lenders who for months now have been concerned that they would not be prioritized when it came to paying creditors, and that those in the mainland would get first dibs on good assets. And finally, Chinese financial media is reporting that the People's Bank of China, China's central bank, has given so-called window guidance to large state-owned lenders and regional banks in recent weeks, encouraging them to extend more credit to companies and households, a sign that the central bank wants more credit pumped back into the property sector. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.